Intel shareholders have sued the US government over demands for company shares. The lawsuit challenges demands tied to CHIPS Act grants. Supporters say taxpayers deserve a return, while shareholders call the demands illegal. Should governments own stakes in subsidized companies? Vote now. Let the government take shares or keep companies fully private. Congress passed the CHIPS Act to support semiconductor factories in the United States. Under a new agreement, $8.9 billion in federal funding bought Intel common stock. The government received 433.3 million shares, creating a 9.9% stake. Intel stated that this public stake carries no board seat or governance rights. However, Intel shareholders sued the government, claiming the original law only authorized direct grants. Tom, does taking shares protect taxpayers, or does it hurt private enterprise?
The Intel agreement shows why public funding must bring direct returns to taxpayers. From a practical perspective, state grants give private firms massive financial benefits. When companies succeed, taxpayers deserve to share in that commercial profit. Look at Germany's Economic Stabilization Fund during the 2020 crisis. The German government bought a 20% stake in Lufthansa for €306 million. It completed its exit 2 years later with sales reaching €1.07 billion. That transaction generated huge net proceeds for the public treasury. Public equity lets governments fund strategic domestic industries while retaining long-term financial returns. During the 1990s, America led the world in making rare earth magnets, but production moved abroad, leaving US factories reliant on Chinese imports. That history shows the risk of judging strategic production only by short-term cost. Today, the US Department of Defense has a team for strategic government deals. Shares cannot guarantee new factories, but they tie public money to long-term results.
Tom argues that equity stakes let taxpayers share in commercial gains. He also says China's magnet dominance shows why public support needs long-term goals. Emily, what is your reaction to Tom's economic and security case?
The recent Intel lawsuit highlights how unexpected equity demands undermine legal stability for private firms. What we cannot ignore is that taking shares creates severe political and legal friction. Intel shareholders sued both the government and board over these forced ownership terms. Congress previously granted explicit equity investment authority to specific agencies like the Small Business Administration. By contrast, federal chip incentives historically operated as non-dilutive grants to support domestic factories. Extracting corporate equity without clear statutory backing invites endless lawsuits and risks political favoritism. Furthermore, state equity stakes expose public capital to heavy market speculation and sudden price drops. Historical economic analysis shows that long-term boom gains flow to technology users rather than initial developers. If private market valuations crash, ordinary taxpayers carry the direct burden of company failure. Capital gains taxation provides a simpler and less invasive mechanism to capture economic returns. Broad tax policy collects revenue cleanly without distorting corporate governance or interfering in markets.
Emily argues that demanding equity without explicit statutory backing causes severe legal uncertainty. She believes standard tax policy captures value effectively without exposing taxpayers to stock market risks. Tom, how do you answer these concerns about legal authority and market distortion?
That concern is fair, but Congress can set the authority before any deal. Congress has already granted specific investment powers to several government agencies. The Intel lawsuit shows why that permission should be explicit, not improvised. Clear rules could define which companies qualify and what rights government receives. Passive equity lets the state support strategic goals without taking day-to-day company control. Intel says the government received no board seat, governance rights, or company information. That leaves Intel's managers in charge of business decisions. If Intel's value rises, taxpayers can share the upside without running the company. That design cannot remove political risk, and taxpayers could still lose money. But it answers Emily's strongest objection without giving officials a seat inside Intel.
Tom accepts that the current dispute exposes a gap in legal authority. His answer is prior authorization plus passive shares that leave managers in control. Emily, can prior authorization and passive ownership answer your control concerns?
We can acknowledge that taxpayers carry immense financial risk when granting billions to private industry. However, converting public grants into state equity creates irreconcilable conflicts of interest. A government cannot remain a neutral regulator while holding direct financial stakes in private firms. State officials face strong political pressure to grant favourable regulations to protect government-owned assets. That favouritism distorts fair market competition and penalises private competitors who receive no state aid. Furthermore, mixing public authority with equity ownership inevitably compromises corporate governance. Politicians will inevitably push company executives to prioritise short-term political goals over operational efficiency. Even passive stock gives government deal teams heavy informal leverage over corporate decisions. Keeping state regulations separate from market ownership remains the only way to maintain discipline. Private companies must answer to their shareholders rather than government ministers. Forcing public ownership onto private businesses ultimately damages innovation and long-term growth. The state should regulate markets fairly, not become a commercial shareholder itself.
Today's controversy over Intel shows how industrial subsidies raise fundamental questions about state authority. The central question is whether state equity can protect taxpayer value without corrupting regulatory neutrality. We must decide if public ownership can strengthen domestic supply chains without destroying market discipline. The South African Transnet case highlights the risks when political interests enter commercial management. In South Africa, state ownership of railway operator Transnet resulted in major operational mismanagement. Political imperatives overrode sound commercial decisions, leading to widespread corruption and heavy economic damage. Advocates argue that passive equity avoids these traps by excluding board representation and voting control. Critics maintain that any government stake creates irreconcilable conflicts between state regulation and commercial ownership. To see which vision succeeds, track two critical indicators over the next 6 months. First, watch the upcoming court rulings in the Intel shareholder lawsuit concerning executive equity authority. Second, observe whether lawmakers pass explicit statutory guardrails for federal deal teams entering commercial deals. Those decisions will determine how governments support private industry in the future. Now let us practice 3 key phrases from today's discussion. First, use this phrase to bring a practical perspective to your point. From a practical perspective, state grants give private firms massive financial benefits. From a practical perspective, public investments must deliver clear returns to taxpayers. From a practical perspective, long-term industry building requires stable government support. Second, use this phrase to highlight a point that demands attention. What we cannot ignore is that taking shares creates severe political and legal friction. What we cannot ignore is who carries the risk when company share prices collapse. What we cannot ignore is how government ownership alters corporate decision-making. Third, use this phrase to acknowledge a fair point before replying. That concern is fair, but Congress can set the authority before any deal. That concern is fair, but passive equity protects taxpayers without taking operational control. That concern is fair, but public funds need protection against corporate subsidy misuse. Which of these 3 expressions will you try in your next English debate? Tell us in the comments below and join us again next time on The Breakfast Debate.